What's up, traders? Happy New Year's. Welcome back to the channel. Hopefully you had a great time with friends and families, but it's back to business with the battle of the bulls and bears set to resume this upcoming week. Not only is Wall Street coming back to the office, but the weekly expected move is forecasting a break of the balance area on the daily time frame chart. We know that the market was closed today on Monday in observance of the New Year's holiday, but it's game on for the remainder of 2023 as the bell rings tomorrow morning at 9:30. Anything that we're associated with is linked down below in the description. A quick thumbs up on the video goes a long way to support the channel. And with that said, let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've got yet again another red-bodied hammer. So sure, buyers stepped up towards the bottom of the lower wick, sent prices in the upward direction, but they were unable to recapture the opening print and thus unable to expand range in the upward direction. So it was bullish, just not as bullish as it could have possibly been. I would really be much more neutral on this particular structure, especially when we consider location. On the bar-to-bar count, we did produce a weekly lower high, but also a weekly higher low. So we've got ourselves an inside bar, and this is happening on extremely light holiday trading volume. Again, much more indicative of balance and neutrality. I would not look at the bullish nature of the hammer structure and say all of a sudden we're looking for a massive reversal on the weekly trend. Speaking of trend, let's have a look at the trend line. There it is. Of course, we're underneath our last set of weekly lower highs. We're underneath the lows of the balance area here. If this were to turn into a more meaningful weekly higher low from this perspective here to here, then three things really have to take place. Number one is breaking the inside bar high. Number two is getting back inside of the weekly balance from over here. And number three, of course, breaking the weekly resistance trend line. That would become obviously much more meaningful, and maybe that's the story of 2023, but one step at a time. Nothing about this hammer candle on light holiday trading volume as an inside bar would suggest to me that a big breakout and trend reversal will happen in the next 4 days worth of trade. We'll reevaluate when and if we close out the week bullish, but one step at a time is what we're getting at. The objective of the weekly trend still being down should be to retest the equal low at 355 roughly in here to determine whether or not we produce a lower low, preserving the weekly downtrend, or we bounce for an equal low and possibly jeopardize the trend from the low perspective, right? So one thing at a time, but for now, of course, the objective remains in the downward direction. As long as we're underneath the bottom of the balance lows here, we're technically in a daily downtrend as well. Let's have a look from the volume profile perspective. Is this making sense as well? I would say that yes, with the added nuance that this is starting to turn into sort of a dual move in this high volume node. Of course, 390 was the main high volume node, but notice last week's lows and the prior week's lows are starting to build out as a high volume node as well. That's going to act as your gatekeeper before possibly rotating through the low volume void here for the quote unquote reset 340, the pre-sickness highs, right? We've been talking about that as a volume target. Now we've got this kind of interesting double tip, if you will, in the high volume node. Just be mindful, the prior 2 weeks lows will be the gatekeeper. Let's have a look from the daily time frame perspective and see what else we can learn about expected move, psychology, patterns, all that good stuff. Expected move is still bearish in my estimation. The upper edge is at 390.86, and if we're contained, it's still a big time lower high from here to here, and it's also well underneath the bottom of the balance area from right around in here. That number is 394.50. So as long as we're underneath that, again, there's no real reason to be overly enthused about bullish outcomes to possibly change the weekly trend. So this is bearish. If we're contained by the lower edge, it's a nuanced lower low from 2 Thursdays ago, which of course is bearish as well, preserving the daily downtrend. If anything, from a pattern perspective, right, this is still bear flag consolidation, and we know if we take a brief and eyeballed measured move, so to speak, from there, it's much closer to that 355 equal low weekly target that we were just discussing. Now, as we pointed out in the intro, the expected move is forecasting, though, a break of this daily balance. Now, I think that something pretty nuanced happened last week around 383.25. Let me show you on the hourly time frame chart. If we have a look here, notice that we have all of these equal highs, all this pressure building up around that area. We breach it on Thursday, get no follow through. It's sideways for a bull flag. Okay, maybe we can get some follow through on Friday. It just wasn't the case. We fell right back down into the daily balance area. This is really not indicative of new money buyers in my estimation. So I'm not thrilled with the buying activity, and I get it. It was a light holiday, trading volume week, so wasn't expecting anything big in the first place. But again, just not reading into that as an overly bullish signal from the market. Now, it's also not that bearish because on Friday we did the opposite. We took out Thursday's low, no follow through, and then wound up closing right back towards that breakout area. So I do think that 383.25 is in play for the early stages of this coming week. And if we do get a break there, possibly looking for that 389.50 target, it's the daily 50 SMA, it's the weekly resistance level, it's the high volume node. And as we know, we've been tracking the anchored VWAPs. I've done something interesting for today's video. I've anchored them to all of the dips of 2022. So 1, 2, 3, 4, and 5 here. And 3 of them, 1, 2, and 3, are confluence of resistance right around this 389.50 area. So I'm still building the case that this is a strong area of resistance that I don't imagine the market wants to just break through instantly in the coming weeks worth of trade. I think that we'll get some hang up around 389.50 based on all of the confluence of resistance around that area. And even dip buyers from back here, basically all dip buyers of 2022 based on average weighted price, they're underwater, right? We're underneath all of these anchored VWAPs, which of course is more bearish pressure for the market instead of bullish pressure for the market. Let's have a look from a Fibonacci perspective to see what else we can learn. Just like in last week's video, not much has changed from this perspective. We're still in no man's land underneath the 38.2, but above the 61.8. And if we take out the fibs from here to here, the 38.2 is still confluence, of resistance around that 389.50-ish area, building the case again for content bear flag consolidation here and possibly a breakdown into the future, searching for those weekly equal lows. Let's have a look now at our market internals. What's going on from the internals perspective? Top right-hand corner's got you covered with a brief tutorial if you don't know what this is. Overall, the inflows really lackluster, and again, we shouldn't have really been expecting anything major. Some decent moves on the Thursday session, again, with that break, but it really does not look indicative of new money buying to me, much more like short covering, right? So sure, it's aggressive here. What happens on the follow-up day? It's back to neutral. It's back to neutral. Really, the tick lights the way whenever we're dealing with these types of situations. Notice that the tick was actually trending lower throughout the entirety of the Thursday session. So again, bullish in the morning, shorts getting squeezed out of their position. No one wants to be short. It's buy, 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 buy. And then into the afternoon, no other buyers are interested, right? And you can see that in the flat cumulative read here underneath our actual tick. So overall, not impressed with new money buyers. And again, wasn't really expecting anything anyhow, being a shortened holiday trading week. Let's have a look at the market profile. If you don't know what this one is, top right-hand corner's got you covered with a brief tutorial on how to not only set it up, but how to read it. Overall, P-shaped profiles are indicative of short covering, and that's exactly what we got on the Thursday session. From there, on Friday, value follows up with a move lower. Point of control definitively moves lower. So again, not impressed with new money buyers. This is not an overly bullish signal. To me, looks much more like a failed breakout up and over that daily pressure cooker top that we saw on the SPY daily candlestick chart. Now, one interesting takeaway from the Friday session is that, of course, we did get that spike into the close, and that's represented by M period. So if we open above M period, we need to auction higher and possibly look for the next area of sellers. If we open in the M period single prints, we are expecting neutrality, and we'll learn something about the market when and if we break the spike. And if we open underneath the M period, then basically what we're looking at is a rejection of these higher prices. That would be the most bearish signal for the market. So use these levels as we move into the open on the Tuesday session. The high is roughly around 38.6350, and the low of the spike is 38.5575. Okay, so use this zone right here. Opening above needs to auction higher. Opening inside, watch for a break or a break. Opening underneath is bearish and rejecting those overhead prices. One interesting thing that we can look at is a composite profile of the entirety of the 2-week balance that we've been dealing with, which is roughly 12.18 to the current day. And you'll notice something fairly similar, right? If we take out this area here, that's basically confluence of the daily breakout level in the SPY. That's 38.80, just above the M period spike, right? If we open there, you can see that a move higher could be in store towards this area here, 39.10. And that would also, if we just go back on over to the platform, have a look at the SPY daily, that would be aligned with what you see right here. That is this move right there. All right. So if the SPY is going to move higher, if it's going to repair that structure, which it very well could, it's up and over 380, 325 in the SPY. In the S&P 500 futures, it's 3880. 3880 would be the number I would watch for that rotation in the upward direction. With that said, let's have a look at some sectors. We're going to go ahead and take off our anchored VWAPs. What's going on in the XLC? It certainly looks much more like bear flag consolidation. A theme of the video when we're looking through the sectors will be, can we find fine. Like if these balance areas break in the upward direction, the true test on whether or not it's going to be a trend reversal will be, can we find a higher low above the balance highs? So keep that in mind as a theme as we move through the sectors. In the XLC, your number is going to be 47.85. If we do something like this and just fall right back down into the balance, not only is it a look above and fail, it's just threatening just continuation in the downward direction with a big time lower high from here to here, also rejecting your daily 50 SMA. So knowing that that's the theme, let's have a look at the XLF. This one's slightly better because we've got much more of an ascending triangle type look. You could call it just a pennant instead of a flag, doesn't really matter. But what I'm noting is the fact that we've got continued higher lows happening here. So a break, of course, wants to see a retest and hold of 34.50. That's your number in the XLF. From a relative strength perspective, XLF is actually performing quite well. I would keep a close eye on this one, especially that 34.50 level into the coming weeks worth of trade. Next up is the XLY. This one is just falling off of a cliff. So even if it does rally, there's no sort of higher low retest that we're looking for. We're just looking for lower highs anywhere underneath 135. This is bearish, and being a heavier weight sector for the market does not really bode well for bullish outcomes in your S&P. XLK, also, the heaviest weighted sector for the market. Doesn't look great. Already broke down underneath the low here. I guess if we're going to stick with that theme, the level is going to be 124.25. If we get a higher low above with confirmation, maybe we start to build out inverted head and shoulders, but one step at a time. I really wouldn't flip the switch back to bullish in the XLK until there's a higher low over 129.50, right? So in the short term, fine, we'll go with it here, but in the long term, it would have to be this for me to get real excited about bullish outcomes in the S&P. Anything that remains underneath 129.50, this just continues to weigh on us as overhead supply, possibly driving the market lower into the future, right? Big time opportunity for a lower high anywhere underneath 129.50. Next up is the XLE energy sector, D for defensive, showing some risk off posture. So just like the XLF, some higher lows in place, ascending triangle type look. If it does break and get the retest and higher here over 87.54, we know that it's risk off. This is D for defensive. We don't want to see it leading the rally in the upward direction. The chart actually looks good, right? It looks much better than something like the XLY, for example. XLB materials. This is a really lightweight sector. This is much more sideways and not really threatening a break of the top of the balance. I would read into this as much more of a bear flag, watching for breakdown and bearish pressure into 74.82. But again, lightweight sector, not going to make or break your S&P. XLP, D for defensive. This is a risk-off type look. Hammer candle off both moving averages, off the horizontal area of support and support from in here. So we'll watch to see if this gets some follow through. I would say, again, you're probably watching for something like this. What would that form? Double bottom, break of the neckline, holds as a higher low, 75.65 is your number. If that happens, remembering that this is D for defensive, not a great look for your S&P 500, much more of a risk-off type posture. Same thing in the XLU. This uptrend has been, really firm over the past couple of months, right? You can see your continued higher lows. You could argue, sure, head and shoulders, right? But it's not really in play until we crack underneath 68.80, and obviously with the long lower wick from Friday, with this supporting there as well, doesn't look like that's in play as a pattern. Instead, the break is over 71.40, something that does this, bullish, and as we know, D for defensive, risk-off posturing. So not looking great for your market in the XLU, continuing to signal risk-off from that perspective. Real estate. Sideways in here, not reading into it too much. Lightweight sector has much more to do with the wealth effect. People will start feeling content, or at least wealthier, up and over 39, and they'll feel concerned underneath 34. So really anywhere in this range here, fairly neutral for the market. Lightweight sector not going to have a lot of pull or push rather on your S&P 500. XLV, second heaviest weighted sector by market cap, continuing to hold up at 133.50. Looks fine, honestly. So you get your break, retest, possibility of heading higher. Remember that this is a D for defensive sector, so it is a risk off type posture, but being the second heaviest weighted sector for the S&P 500, it needs to participate in upward rallies with an aging population and sort of the macro trend of 2022 and 2023 looking forward. Aging population, demand for healthcare is likely going to continue in the upward direction. I can see this holding up and possibly offering some neutral scenarios for your S&P 500. So watching the XLV, don't want to get too wrapped up in the macro narrative there, but it makes sense to me that this could hold up just fine into the beginning stages of 23. Next up is the XLI. What's going on in industrials? You'll notice we're getting sideways balance underneath the overhead supply. So bearish until proven otherwise. Again, break, retest, and higher low needs to be above your 99 level right here. Let's have a look at the ratio grid. If you don't know what the ratio grid is, I've got you covered with another tutorial, top right-hand corner, to learn how to set this up. Overall, the top four are the risk-on sectors. Do we look risk-on? Not really. XLK, the heaviest weighted sector, pointing in the downward direction, getting some bigger distance between the 50 SMA, which is the gold line, and the white line for the ratio ratio price. XLV, D for defensive, as we pointed out, but looking okay there. XLF is where we said that there's a possibility for some legs up and over that 34.50 level. I would keep an eye on this one. XLF to me looks like the best of the heavyweight risk on type sectors. XLY continues to fall off of a cliff here. Not the look of a risk on market by any stretch of the imagination. Maybe some concentrated strength in financials. The bottom four are the risk off sectors. Notice that they're all pointing in the upward direction. None of this is risk on. This is all posturing of a risk off type market. So not impressed with our ratio grid. Nothing about that is indicative of a massive turnaround or rally. XLY over the XLP, so growth versus value. Still, a little bit of lift. Oh, look at that little lift into the end of last week. Nothing more than a counter trend rally and an aggressive downward break. You can see that we're well underneath the lows from here. We're well underneath the resistance trend line. This is bearish for your S&P 500. Let's have a look at the dollar up next. Dollar's actually doing something interesting here with a little bit more of a firm break underneath the lows on Friday's session. I was much more watchful of this as a falling wedge, which is a bullish pattern looking for higher. Obviously, that's downward pressure on equities. But with the close on Friday underneath, and actually a confirmation as well, I don't know if you guys follow the GC, but gold breaking out and closing above as well on Friday. So let's get that out of there. Closing above on Friday, right? We had a couple of failed breaks in the past. Is the fourth time the charm? Maybe. And if that sends the dollar lower, that would actually be slightly helpful and positive for your SPX. So continuing to monitor that relationship there. TNX signal study is up next, as you may or may not have watched last week's video. We finally got the cross from negative into positive territory, which, as we know, continues to put a lot of pressure on the XLK being the heaviest weighted sector for the market. We would expect bearish outcomes going forward, as you can see here and as you can see here when that signal study fires. So not really feeling too happy about the TNX and the rapid increase in rates over the past couple of days. Speaking of rates, let's have a look at our FOMC sort of meeting probabilities. What you'll notice is that we're continuing to bounce around. Some days we're pricing in a rate cut in November. Other days, like today, we're pricing in a rate cut as soon as July. So remember that the further the rate cut gets pushed towards the present, it's more indicative of the Fed needing to bail out the market, so to speak, and offer some relief from a possible earnings recession. So that continues to be the narrative here from the Fed Watch tool. And I would just quickly point out as well, let's think about the business cycle, right? We haven't brought this up on the channel slightly ever, but if we're moving in a stage of business cycles, right, we want to sort of find bonds bottoming first, commodities sort of topping, and then maybe the stocks will start to follow in the upward direction. If we're looking for this cycle to unfold, bonds need to start bottoming and commodities need to start topping. Are we seeing that type of action? Well, with the Fed raising rates, bonds are not really bottoming just yet, right? If we go on back to the platform and have a look at this chart over yonder that we've prepared for today's video, what we've got is equities in a downtrend, we've got bonds in a downtrend, and we've got commodities in an uptrend, right? So nothing about this yet is indicative of the business cycle changing. What we need is much more downward confirmation in commodities. That's showing an easing of inflation. We need bonds to start picking up. They'll start outperforming as stocks continue to get hit based on earnings compressions. And then finally, stocks will start to turn in the upward direction. Nothing about this is indicative of the business cycle changing just yet. So things to be mindful of, right? So if the Fed does bail us out sooner rather than later, maybe that starts to become a little bit more constructive for bonds moving in the upward direction, but one step at a time, right? Just continuing to monitor these relationships right here. And speaking of, right, the TLT, let's have a look at the relative strength line on the TLT. Here we go. TLT has actually been, falling out of its relative strength. We've been watching for this sort of defensive, typical safety move, right? And that's sort of unfolding or unraveling, if you will, in the past couple of weeks worth of trade as rates have continued to move in the upward direction, right? So overall, not out of the woods from the macro narrative perspective in the business cycle. Let's have a look at the HYG, just continuing to indicate a confirmation of lower risk appetite out there in the market. No one's really being aggressive in the high yield, and typically we've been watching these divergences. So we'll see if the S&P breaks down and ultimately confirms what's going on here in the HYG, or if the SPY is going to get it right this time. It's got it right for the past two in a row. We'll see what this relationship continues to be, but so far, no one taking risk in the high yield. Let's have a look at the SPX A200R. All I would point out here is that we're getting continued weeks worth of prints underneath the 50% mark. This is companies trading above their 200 SMA in the S&P 500. The longer we spend underneath 0.5, the more bearish it becomes, looking for continued downward pressure in the market. If it can recapture, because we're fairly close, and get something that starts to be constructive in the upward direction, maybe we're going to narrowly avoid the earnings recession. So watching that, but as of right now, the more time we spend underneath, the more bearish it becomes. Let's have a look at some volatility products to round out the S&Ps. What do we see in the VIX? Continuing to get sort of that double bottom type look here and here. So will this take off in the upward direction if we break the balance lows? It's a possibility, right? As we start to come into, if we come into the weekly lows around 355 in the SPY, I would imagine that that does lead to some sort of increase in your VIX over here. And you'll notice that, the door is wide open, so to speak. If we look at the VVIX, the volatility of the volatility index, complacency effect in full swing as we're just, really at these quite historic lows, given the fact that we're in a market downtrend, a bear market around 75, right? These are historically low readings. Nobody's buying SPY puts, nobody's buying VIX calls. If everybody rushes into the same place at once, we get sort of that gamma squeeze in the upward direction. And of course, we know what that means for the market. The moves will be much more violent than anyone could have possibly expected, up or down. Doesn't really matter what direction. That gamma will dramatically increase as volatility increases as well. Let's have a look at our Contango versus backwardation. This is continuing to come off here. A little bit interesting. There's a divergence in the VIX 9-day versus the VIX monthly, but I think the sort of, end-all be-all is if we take a look at skew, where is our skew? It's the bottom here. Skew is actually headed back down towards that 113 level. So 30-day tail risk in SPY options, very, very low, or at least the market's pricing it in that way. And typically this is, not marked exact bottoms, but, the market tended to move higher after this within a short period or a short number of weeks following, right? So this to me is a little bit more of a bullish data point, but again, really, really focusing on that VVIX and the complacency effect. I would just be open to a large amount of volatility coming back into the market in the early stages of 2023. Let's have a look at the QQQ. What's going on in the Qs? Much more bearish over here, obviously getting closer to the equal lows already in the QQQ and the Nasdaq 100. I would watch out for bearish outcomes here underneath the low of last Wednesday, which is going to be at 260, right? And that's bordering on a breakdown of the weekly expected move low. But really, to me, this is enough sideways consolidation. We had a compressed week in terms of volatility with the holiday trading. I wouldn't be surprised if the market does something impressive here and possibly on some bad news breaks down into the early stages of 2023. If you guys are not watching the economic calendar, you should be lots of economic data coming out this upcoming week. I would be mindful of a couple of things: JOLTS job openings, FOMC meetings, ADP non-farm, the true non-farm, and then the unemployment rate into the Friday session. Really a jam-packed Friday in terms of, we want this, jobs data coming out. So be mindful of that, and that could easily be a catalyst to move the market in the coming week. We're going to start to see if those Q3, Q4-ish layoffs from the big tech companies start to ripple into the data. It's not going to look great for the market, although the Fed does want to see a loosening labor market, right? So overall, QQQ, just to give you the numbers, 263, that opens the door into the 260, and then obviously after that, it's 255.25. If the market does see a bit of a rally, it's over 268 in your QQQ. Overall, if we were to throw on the anchored VWAPs, we're still underneath all of them on the QQQ. Dip buyers are not being rewarded at this point in time. That's bearish pressure for our market. IWM, Russell 2000, last but certainly not least. What's going on here? We know that this has been the bearish of the bunch. It's been leading the way. It's putting in a balance area underneath, big time, underneath the overhead supply, threatening this level. So that's going to be the equivalent of that 383.25 in the SPY. It's 174.50 in the IWM. Remembering that IWM has acted as a leader. A couple of interesting takeaways from this chart. Last Wednesday, we undercut the previous Thursday's low. From there, we rally. We still get that fake break up and over the pressure cooker top, but the fact that sellers did not materialize here, the fact that we're not trading closer to the lows at 171, maybe it's slightly more bullish. Maybe we do see a little bit of upward lift out of the IWM, which acts as a market leader. A little bit more risk appetite out there. Maybe the HYG is actually, the SPY will call the bluff of the HYG. It's a possibility based on some of the divergence that we're seeing specifically in this IWM chart. It's lit the way in the past. Maybe it will continue into 2023, open to the possibility up and over 174.50 for a little bit of a bullish counter trend rally early on in the coming week. And then, of course, we would just look for that rejection in the SPY much closer to, as we know, 389.50. So that's what I've got for you in the broad market. Let's dive into the companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. With that said, we'll dive right into Apple. The main level to be watching in Apple is 130. If we can take out 130, there's a opportunity to retest the lows from in here at 134.85, and then we would reassess the chart. I would imagine that because we are in a daily and weekly downtrend, we would look for a lower high around this area and continuation in the downward direction. If we continue lower without breaking 130 first, underneath 127.50, the two equal lows from Thursday and Friday of last week will open the gates to 123.50 in the downward direction. Next up is Netflix. What's going on over here? Much more balanced in terms of this area here. Just like we talked about in IWM, look at the undercut from Wednesday of last week. Lower low was made, but where are we trading? Right back up towards the top of the balance here. I would just be mindful of the gap fill over 303 into 314.32, and after that, looking for the equal highs at 330. Netflix has been a relative strength monster over the end of 2022, so we'll see if that continues into the early stages of 23. Underneath the lows at 277, that's where the bears are more content through this breakdown here into 253.25. Next up, Tesla. This one falling off of a cliff, getting a little bit of reprieve late last week. Is the short covering rally going to continue? You would just watch for a move over 123.75 and just walk these signposts up one after another. 137.25, 148, 159.50. As of right now, it feels like you might be catching a falling knife, but if we build out something slightly more constructive with a higher low, maybe there's an opportunity to start taking some long-sided risk in Tesla on an oversold type bounce. If it just gets flag consolidation down here, step aside, continuing in the downward direction, 93.75 is the next big time support. Google's up next, really more balanced, much more like our market going sideways over the past week or so. Over 89.50 gets interesting for a move through the thin structure here. Retarget the 50 SMA because this isn't a daily and weekly downtrend, looking for a lower high opportunity around that 94.65, 94 even. If we break down from the balance, it's just a bear flag sort of breakdown like this. First target underneath is the equal low here at 83.40. And do we have anything underneath? Nothing mapped out, but we'll update you on Wednesday if the breakdown does occur. Next up is Meta. What's going on in the metaverse? This chart continues to look sloppy and ugly to me. I would not want to get involved until we can resolve this balance area. Really, really choppy through here, in addition to the really light volume. So over 124.10 fills the gap 128.40, or under at this point 109.25 gets interesting to retarget the gap underneath at $100.80. Next up is NVIDIA, giving back a lot of the gains of this sort of bull pennant that tried to break out over here. Nonetheless, moving into this upcoming week, I would watch for the two equal highs. Really just watch, it was a two-day balance, Thursday and Friday, right? So over 146.25 gets up towards 152.50 SMA. Again, looking for lower highs now that we're confirming a daily downtrend with this move here. We made the lower low underneath. Right? So daily downtrend, looking for lower highs, something that does this into the future. If it's more constructive and does this, one step at a time, you would want to see the higher low above 152. If we do continue in the downward direction, a little bit tricky to play the two equal low breakdown. I would probably be more happy about a break of 137.75 to rotate lower into 130.50 on a downside target. Next up is Microsoft. What's going on with Softy? You can certainly see, again, much more of a balanced range over the past week, watching for continued price acceptance over 239 even for a rotation for the lower high search anywhere underneath 247.75. Remember that we had a failed break here, tried to bounce off of the equal low. It was a lower high breakdown, got the next lower low. So definitely in a downtrend in Microsoft on the weekly and now daily time frame chart, looking for lower highs, ideally 247.75. If it does break down, it's all about the gap, right? Underneath these lows at 234.25, closes down towards 228.50. Last but certainly not least, we've got the mini beast. It's Amazon. What's going on over here? Fake break from Wednesday's move, right? And this is sort of right in line with what we were discussing in IWM. If it's a fake move and the sellers got trapped here and we rotate over the three equal highs from 85.44, that's where maybe you get a little bit of a squeeze in the upward direction. Big resistance at 87.75 coming from the lows here as well as here. So I'd be mindful of that. But, quick intraday scalp, certainly worth watching over 85.44 and seeing what the reaction is at 87.75. If we get a lower high there and fall back down into range, you guys know the deal. It's obviously looking for lower. If we get a constructive higher low, maybe we can change the trend off of some sort of inverted head and shoulders, but one step at a time. The higher low would need to be above 85.44 and threatening acceptance over 87.75. No additional trade ideas for us on the video today as we're headed into a shortened trading week. We want to see how the beginning of the year unfolds. So with that said, again, I hope everybody had a great holiday season. Hope you are able to kick off 2023 with green in your portfolio, and we'll keep you updated on the Wednesday session for the midweek market update. Join us live tomorrow morning at 8:30 here on the channel for the pre-market prep. And with that said, everybody have a great trading week.